Everyone wants to feel like a genius when they put their money to work, but very few people actually want to do the grimy, unglamorous math that happens after the initial excitement wears off. I see this debate play out every single day in the finance world. It usually starts at a weekend barbecue or in a heated comments section, where one person swears by the tangible power of real estate, and the other insists that the stock market is the only true path to passive freedom. My name is Maaz, and today I want to pull back the curtain on a story that most people only tell in fragments. We're going to look at two different lives, two identical bank accounts, and 20 years of choices that lead to the exact same destination through two completely different versions of hell and heaven. To keep this a fair fight, we have to start on a level playing field. Imagine two friends, Jake and Marcus. They are the same age, live in the same city, and both earn a respectable $55,000 a year. Through years of discipline, they have both managed to scrape together $50,000 in cash. This is their seed money, the capital that is supposed to change their lives. Jake is the guy who likes to touch his investments. He wants something he can walk through, paint, and insure. He takes his $50,000 and uses it as a 20% down payment on a $250,000 three-bedroom rental property. He signs for a 30-year mortgage at a 7% interest rate, which puts his monthly payment at roughly $1,330. He finds a tenant almost immediately who agrees to pay $1,800 a month. In Jake's head, the math is simple and beautiful. He's collecting $1,800, paying the bank $1,330, and pocketing $470 a month in pure profit. He feels like a tycoon before he even gets the keys. Marcus, on the other hand, is the guy who prefers to stay invisible. He doesn't want to talk to tenants or worry about property taxes. He takes his $50,000 and dumps the entire thing into a total stock market index fund. There is no leverage, no debt, and no keys to hand over. To make it a bit more interesting, and to reflect his commitment, he sets up an automatic contribution of $300 a month, money he would have otherwise spent on hobbies or eating out. And then he essentially forgets the account exists. When people at work ask him what he's doing with his savings, he tells them he's buying index funds. They usually nod politely, lose interest within 5 seconds, and change the subject to something more exciting, like crypto or real estate. Marcus doesn't have a story to tell at dinner parties. Jake has a house. Marcus has a confirmation email. In the beginning, it's not even close in terms of social status. Jake is a property owner, while Marcus is just a guy with a brokerage account. For the first few years, Jake is absolutely living the dream. Every month, like clockwork, the rent check hits his account. He drives past the property on his way home and feels a genuine sense of pride. He sees the grass being cut, the lights on in the windows, and he thinks to himself, I own that. On top of the cash flow, he's getting some sweet hidden benefits. He's claiming mortgage interest and depreciation on his taxes, which shaves a few $1,000s off what he owes the government every year. He's building equity with every single payment the tenant makes, and he's watching the Zestimate on his phone tick upward as the neighborhood appreciates. It feels real, it feels tangible, and most importantly, it feels smart. Meanwhile, Marcus is living a much quieter, more boring reality. He logs into his account once a quarter, sees the balance go up a little bit, then down a little bit, then back up. It doesn't feel like wealth. It feels like a fluctuating number on a screen. The social gap between the two friends is massive. Jake looks like he's winning by a mile because his investment has a front door and a mailbox.
But this is where the reality of the landlord life begins to collide with the spreadsheet. By the end of year 3, Jake has collected nearly $65,000 in total rent. His mortgage payments have eaten up about $48,000. On a napkin, it looks like he's up by $17,000. But the napkin doesn't account for the property taxes that cost him $3,000 a year, or the insurance that adds $1,500. It doesn't account for the Tuesday night when the water heater gave up the ghost, costing him $1,200, or the heavy storm that required a $2,800 roof repair. After all real costs, Jake's actual net cash flow over 3 years is somewhere around $3,000. Marcus, meanwhile, has put in his initial $50,000 plus $10,800 in contributions. At a 10% average annual return, his portfolio is sitting at roughly $76,000. He has spent 0 hours managing it. He hasn't taken a single emergency phone call or coordinated a single repair. He hasn't even broken a sweat. Jake still has one massive advantage that Marcus doesn't: leverage. His $250,000 house is now worth $280,000. Because he only put $50,000 down, that $30,000 gain in value represents a massive return on his actual cash invested.
The real divergence happens in the second decade. By year 20, the math fully separates the two paths. Jake's property is now worth $500,000. His mortgage is nearly gone, and he's finally seeing significant cash flow. But the house is 20 years older. It needs a major renovation. Over 20 years, his net profit from rent, after all headaches, might be $60,000 above what he spent. Marcus's portfolio has exploded to over $450,000. He's contributed about $122,000 total, but the other $330,000 is pure compound interest. He has no debt, no tenants, and no 2 a.m. phone calls. He has total liquidity. If he wants to sell, he can do it with a click. Jake is house rich but cash poor until he decides to sell or take out a loan. The tragedy of this entire debate is that most people pick a side based on a headline or a podcast clip without ever looking at the all-in cost. Jake and Marcus both thought they were making the smart play, but the winner isn't the guy who picked the better asset class. It's the guy who picked the path he could actually stick to for 20 years. I want you to realize that you don't have to navigate this journey alone. The reason I started this community is to provide you with the exact roadmap you need to stop stressing and start growing. If you're ready to take control of your financial future and move away from the paycheck-to-paycheck cycle, you've found the right place. Join the family here at Money Pulse by hitting that subscribe button and turning on notifications. We're committed to giving you the practical, real-world advice that actually moves the needle. Let's stop chasing the appearance of wealth and start building the real thing together. Thanks for watching, and keep building towards your great, big, beautiful tomorrow with Money Pulse. Because the only math that matters is the math that includes everything.